To the extent that I think it's a demand problem, I do think that impacts the nominal side. I mean, if you send checks to people, they can buy more things until you have more money chasing fewer, the same goods or fewer goods, which is very different than the 2008 response, right? They didn't send checks to people or give them child care tax credits, which are basically another type of check, right? So we actually filled up people's their checking and savings accounts rather than just bank reserves. So we do have a demand surge, but a lot of it was just, some of it was elevated demand. Some of it was shifted demand. So taking out of one category and you couldn't travel for like 2 years, and shifting that over to like, say, at-home doorables, right? So making your home better. You had a rapid shift in demand. And right now, what we're seeing, if you look at, say, retail sales, you see a very big difference between nominal retail sales and real retail sales. So people are paying, on average, 9% more. For many types of categories, it's higher. It'd be low double digits more than a year ago. But they're not taking more home, right? So if you look at nominal dollar terms, demand for goods and services is up, but the actual amount that they're taking home is really not that high. And that's, I think, why you see literally record low consumer sentiment, according to, say, nationwide University of Michigan surveys, right? So people are in aggregate rather miserable. And I mean, they have like 6% wage growth versus 9% inflation officially. If you look at house prices, or if you look at rent prices, or if you look at, say, let's take high protein foods, right? I mean, they're up like 14% year over year, right? While wages are up 6%. And so, we're getting basically a surge in demand for nominal terms up against a supply constraint, but we're not really buying more things. And so it's really that blend of the demand side and the supply side, along with some degree of currency debasement itself. If you look at, say, oil and gasoline prices, so let's say oil, oil as denominated in gold, right? If you were to measure how many barrels of oil can you buy with a gold coin, it's not like unusual right now, but oil is relatively high in dollar terms, and so it's about the capex cycle and things like that, but it's also about just more units and some degree of debasement. So if you look at Europe, I mean, their natural gas prices spiked in late 2021, which is before the war. Obviously, the war has added volatility and uncertainty to the whole mix, right? I mean, that's unmistakable. But it did not create the problem. It's an overlay onto a problem that was already there. And so, to some extent, commodity cycles, they roughly go in these 10 to 20-year cycles, right? There's periods of underinvestment because prices are low. There's oversupply. Nobody wants to put new money into it. Eventually, demand keeps ticking up, and the existing supplies dwindle, and that starts to result in more scarcity, a big price spike, and that encourages more investment to eventually come into the space. And so those are somewhat unavoidable. And so when you combine one of those with fiscal stimulus, monetary debasement, that sort of thing, you get a pretty big rapid response in terms of prices and scarcity. As for the Fed, they have some levers here because, for example, they can try to harden the dollar versus foreign currencies. That can squeeze emerging markets that have a lot of dollar-dominated debt, which can then curtail their demand to some extent, as well as curtailing American demand. Basically, you're hardening everyone's liabilities, and liabilities exceed money supply, right? So, I mean, if everyone's debts are getting harder, and if you're seizing up the domestic housing market, you can curtail demand temporarily, pretty significantly. So I do think the Fed is having an impact. They're not quote unquote powerless, but I think they can't fix the underlying issue, which is supply side. And I think we can also bring in Ray Dalio's long-term debt cycle conception. I mean, we've had decades of falling interest rates all the way down to zero, or in some cases negative, rising debt to GDP. When you get over 300% public and private debt to GDP, there's really not a lot, and then interest rates are zero, so you can't just keep lowering your interest costs, your servicing costs. You're kind of out of road in terms of credit expansion. And so those debts become increasingly hard to service. And one route is to choose like the nominal default path. Like, we just kind of can't pay some of the debts back. But then you get that vicious feedback loop downward. So instead, what policymakers normally choose is negative real rates. And so it's kind of like a way of spreading out the losses. Everybody gets a haircut in real terms. So those bonds pay everything they owe in dollar terms, but a dollar buys you less. And so that's the environment that I think we're in now, which is debts are super high. We're going to have negative real rates for, the majority of this decade. There could be brief periods where we manage to get a briefly positive real rates, but I think that most of the time will be negative real yields. And that the Fed has tools at their disposal, but in some sense, they're doing a policy mistake in response to a policy mistake, right? So they were probably too loose while, money supply was exploding and people were pouring into like Dogecoin. And whereas now, and they were calling inflation transitory, saying that, this is like a temporary thing. Then they said, okay, this is a mistake. Now we have to fight it. But now that they're fighting it when you already have an economic contraction. And so I do think it's essentially a policy mistake, but I think it's almost a preordained policy mistake, because if your official mandate is to maintain price stability and maximize long-term employment, if you have 9% inflation and 3.6% unemployment, you're pretty much forced to try to increase unemployment and decrease official inflation. Now, you can take it, a more cerebral approach might say, well, I mean, this is supply side inflation, this is XYZ, you shouldn't do this. But, as for their mandate, that's kind of what they have to do. And if you survey people, there were surveys that said, okay, what is your biggest problem? What do you think's wrong? How are things good or bad? The biggest answer was inflation's too high. And like the second and third biggest answers were rent prices are too high and gasoline prices are too high, which is another way of saying inflation's too high. And then very low down on the list was labor market weakness. So both politically and just following their mandates, they're kind of forced to, try to tighten temporarily, even if it's not intellectually the best thing to do. It's kind of a forced policy error. So I'm looking for one of three different outcomes. One would be outright recession and labor market weakness. So let's say unemployment goes from 3.6% to 4.1%, which is actually in line with their predictions. I mean, it's funny, they're actually predicting higher unemployment and then doing policy to try to have that happen. But if that starts to materialize, I mean, if you have outright recessionary quarters and you have employment over 4%, that's a pretty strong sign for them to pivot. The other two are more about financial market liquidity and stability. And so, for example, the Fed had to pause rate hikes in early 2019 after, the famous Powell pivot. And a lot of people saw that the S&P 500 fell 20% and assumed that's why they had to pivot. But really it was because credit markets, junk bond markets, there was no junk bonds issued for like 6 weeks. The whole market froze. And that's a more immediate problem for the economy and the Fed than asset prices going up or down. And so the second thing I would say is credit markets freezing. Right now they've been, spreads are rising. It's not a very healthy market, but it's not a broken market. So if that market outright breaks, I think, especially combined with the other problems, you could get a pause or pivot. And the third one would be treasury market illiquidity. So we partially saw that in late 2019. You had the repo rate break, but the repo rate, that was a lot of that was, hedge funds were borrowing repo to buy treasuries. So it was kind of close to the treasury market itself. And that's why the Fed ultimately had to buy more T-bills in response to that rather than just fixing the repo market. We also saw that more acutely in March 2020 when you had, the global economy shut down, dollar spikes, some foreigners have to sell treasuries to get dollars because they have a dollar shortage, treasury market becomes illiquid, Fed reliquefies treasury market. And so I think either treasury market breaking or credit market breaking or, severe obvious recession and labor market weakness. Those would be three signs that would lead the Fed to pivot. I think that in normal market conditions, if we saw what we saw right now, which is yield curve inversion, pretty clear recessionary signs, you probably already have a Fed pause. You probably would have them not raising rates in this environment. But I think because inflation's so high, and I think because of prior policy errors and kind of say, for example, James, Powell being mindful of his legacy, I think they're going to push it a little bit further than they might otherwise would until they run into a more obvious sign to stop. More obvious.